Welcome, everybody. Good evening, everyone. Welcome to the three class of the free trading classes. Without further ado, this is 9. I couldn't drop what we'll be taking though because I was busy, but the PDFs are on the drive, so I sent that to everyone's email. Right. So if you check the drive, yesterday we were on yesterday we were on type. We stopped at types of charts. Right. We stopped at where I explained we have three types of chart. We have the line chart. The other charts though, but the most widely used chart type by traders everywhere is the line chart, the bar chart, and the candlestick chart. Right? Alright, so without further ado, okay. I showed you guys how this is the line chart. Showed you guys on the charts on the the trading view chart. Let me load the trading view chart. Hope you guys can see my screen. Can you guys see my screen? Please unmute yourself and answer, please.
Sorry, it's only the Telegram screen, no, not the other chat screen.
Okay, let me fix that. Alright. Okay. Now can you see my screen?
Yes, sir.
Alright. So this is the trade I took. Went in profits, came back, took us out of break even. I don't have any interest in taking this trade again, but it looks like to buy from there again. Hopefully tomorrow, but let's see what happens. So now back to the types of charts, right? We have this is the candlestick chart, right? This is the candlestick chart. Then we have the line chart. This is the line chart. They are all lines. Then we have the bar chart. These are bar charts, right? These are the types of charts commonly used. All these bars here represent information. They represent transactions that occurred in the market at certain times at certain interval. There are a bunch of transactions that occurred in the market. People bought at this zone, people sold at this zone, people bought to this point, people sold to this zone, people bought to this point and sold to this zone, right? People that is even showing here that information that the market sold down from here to this point, right? Card gained straight over odd and sold, odd gained straight over card and sold down. Then card gained strength and took over the market, and there we go. All right. So this is the bar chart. It's a type of chart. This is the line chart. So basically, most times I use the line chart, and I also use the bar chart, the candlestick chart. Right? Okay. So now going back, the PDF contains everything. The PDF on the drive contains everything. Talking about the line chart, explaining how people use it, but the only issues with the line chart is that there's no contrast showing the daily time frames. When the bar chart and the candlestick chart, you can see the daily time frames, the transaction that happened in the day. Let me explain this. Now, on this chart, this is the candlestick chart, right? So now each candle represents a day. Each candle represents a day. Each candle represents a day. If you can look at this here. Let me put a line here. Look at this day. You will see the dates here. This Tuesday, 29th April 2025, right? See it here, the blue cursor below here. So now this blue cursor is showing that this is the date, this is the day that these transactions held, uh, the transactions went through, right? So now in this transaction now, it's telling you that this whole day, this candle is telling you that this whole day, this is what happened. And what happened here is this simple. What happened here is this: sellers took place of the market. The market sold and closed bearish that day. The next day, market opened, and this is like an initial candlestick. We'll talk about types of candlestick today, right? Where I'll explain the types of candlesticks, the candlestick patterns, the beginners part of candlestick patterns, so that you guys can easily understand. So I explained um, candlesticks and the information they pass. So like this now, I told you guys normally on a normal candlestick you expect to have a bearish and a bullish candle. So for me, instead of taking this to be as my bearish, okay, let me do something. Let me change this to the normal candlesticks that we know. Please hold on, give me 5 minutes. Let me rearrange this. Okay. Is that 70? Is that 81? Is that this? Okay. Red, red. Okay. All right. Are you guys there with me?
Yes.
Okay. All right. So now the candlesticks, right? So I was explaining each candlestick shows. Please. Okay. Thank you. So now each candlestick shows the data that happened. So let's say for this candlestick, this bearish, this candlestick here. Remember yesterday we talked about types of candlesticks. Mm, okay, not here. Talked about candlestick that was on the PDF. So now here, this is a bearish candlestick and this is a bullish candlestick. Remember, I told you guys what happens in the bullish candlestick. The market opens at this price. Market opens at this price. And remember, mind you, this is a daily time frame, right? This is a daily time frame. So all these candles represent one day, one day. So this is what happens. These are the transactions
Class.
Alright, guys, I'm very, very sorry. Network. Wi-Fi logged me out. I'm sorry. Let me share my screen again. Sorry about that. Sorry about that. Network logged me out. Right? I'm very, very sorry. So now moving forward. Where was I? Alright. Now I'm talking about the candles. So now bear in mind, since we're on a daily time frame, right? Since market open at this price, right? Shows that when you're talking about a bullish candle, it means that the buyers took over the market. The market was bullish. Buyers took over. When you talk about bearish, talking about sellers, sellers took over the market. Took over the market. Once we are talking about different trading technologies, we will all talk about that. I will talk about those terms, right? So now, because this market is bullish, this candle is bullish, shows that the information is here. Buyers opened at this price, and people were buying, 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 buying. At the end of the day, where did the market close? The market closed here, right? The market closed here, right? So the market closed at this point. Though it shows now, what happens is, let me explain. Someone asked me about these wicks. Now, what happens? Someone asked me, why is this wick here? What happened is this market, once market opened from here, it came down a bit. Sellers were trying to sell price up, but it came down a week, showing this week here, showing that okay, market came down to this place, right? At some point before going back up. Do you get me? Came back to this point at some point before going back up, before buying back up. Same thing with this bearish candle, this red candle. Now, what does this red candle tell you? It tells you that what market opened where market opened here, open. Then buyers came in and pushed the market, tried pushing the market upward. Hence this long week. Hence this long week you're seeing here. Hence this week you're seeing here, right? That's why I tried pushing the market from here upwards. Sellers still came back and pushed the market downwards. And they closed, eventually closed bearish, closed red. Do you get? Alright, so each daily candles here on the chart, on the candlestick chart, represents information, transactions carried out in the market, right? So many people use the candlesticks to do analysis, while some use the line chart. Now, why many don't really use the line chart? Because now you can see in that candlestick each day, each day you can see the information that was the information, you can see the information and the transactions that held at that day. But here on the line chart, you can't see that's just basically lines. You can just see the market going up from this point to this price, from this price to this price, from this price to this price. So now basically when I'm trading KTP concept, I use the line chart to find key levels, and when I am trading the candlestick chart, I use my normal concept of liquidity. So that's that for that as far as that is concerned. Moving forward. So I've talked about the types of charts. Though those there are some errors I found in this PDF which I'll need to correct, and I'll still upload it on the drive, right? So some errors I'll need to correct. So once I'm done with that, I'll drop it for you guys. So now I'm going back to the topic of today. Common Forex terminologies. Common Forex terminologies. Please, are you guys with me?
Yes, I see.
common forex terminologies, right? So forex terminologies Forex technology is just like every other profession. Forex trading is just like every any other profession or area or specialization out there in terms of using terminologies and codes to communicate. Right? You agree with me that any business you go into, or let's say all departments in the tertiary institution has their way of communicating or words they say among themselves that outsiders won't understand. That's the same thing that happens in forex. Even boys on the street have their own code of communication. For you to communicate effectively with other market analysis, forex gurus interpret news, flow with your colleagues, interpret news, flow with your colleagues, etc. You need to learn and get to know some of these terms in forex trading. Let's dive into it. So now in forex trading, you have the what we call the bulls, which is in terms is the buyers, the forex market. Bulls. I explain to you guys when you say the market is bullish or bulls. When you hear usually you hear that with crypto, you hear they say Bitcoin is bullish. Bulls means buyers. People are buying. Remember, I explained that market is demand and supply. So once you're buying from a zone, once people, the demand for a particular coin against another pair is being, yeah, let's say you're putting collecting like Bitcoin and you're buying Bitcoin at a demand zone, right? The demand for Bitcoin is high, so that's why people are buying it. So once people start buying Bitcoin and the demand is high, because demand is high, the price starts rising. So once there's too much circulation, right? There's too much supply, people start selling. Do you understand? So it's known as the bears, which is the bearish market, right? Then the bulls, the process of when they're buying and the market is going up, referred to the bullish market, the bulls, where buyers the first market are referred to as bulls. Same as bearish. Bearish is the sellers. Sellers are referred to as bearish, right? Now another is a bullish market. A market that goes up is a bullish market. So let me give you an example of a bullish market. Let me go like this. This guy is behaving funny on this odd card. Right. Okay. This is an example of a bullish market. Why? Because the market is going up. What is it doing? It's going up, comes down, it goes up, comes down. So going up. So have you seen why I expected to buy, why I took this buy from this point? I expected this market to go up. Why? Because from here, this guy is bullish. That's why I was expecting this trade to go up here and give me profits. Right? This is an example of a bullish market. Now vice versa, let me flip the chart upside down. Example of a bearish market. See, the market is going down. And all it's doing is going down. So all it's doing is going down. They go down. So if someone wants to take the market as it was, someone will be looking at selling. So now this market is bearish, right? The bearish market because it's selling. Then we have the bullish market. This market is bullish. Now here too, can consider here as a bearish market. Why market sold from here down here? It's bearish. Let me clear a typical example of this bearish market is the Bitcoin. Let me load the Bitcoin chart. All right. So now okay, the Bitcoin is very clear. The bulls and the bear. So now Bitcoin, since the offset at the launch of Bitcoin has been bullish all time for the monthly and bearish in some ways, right? So now let me explain. Now this is the Bitcoin chart, right? You look at it, market came from here, came down. Let me use this part too. Came from here, went down, went up, all the way up, came down, went all the way up. went all the way up here, right? So now this move from here, now this move from here to here is known as a bullish move, right? So market came back down here. As market came back down to this point here, right? It bounced back up again. Then let me arrange this. Then came back down. So now this move, as it was going down, is the bearish move, right? It's called a bearish move where the sellers, everybody's selling of their Bitcoin. They're selling, and the price is going down. So now there was demand of Bitcoin when at what year? At 2021, December. Let's December 2020, I think January 2021, 2021, there was demand, so people were buying, and the more demand for a commodity and equity, the more the price skyrocket. So you can see Bitcoin was here at $12,000 per Bitcoin, and because of demand, it pushed price to 60K per Bitcoin. Then there was too much supply, it now started selling. So that's why I say first it's simply your economics, demand and supply. Understand that, and that's everything about Forex. The rest is a strategy that plays around that common formula. If you're going against if the market demand for a particular coin against another for a particular currency against another currencies, the base currency against the quote currency is high, and you're going there to go and sell instead of to be buying with the market, right? You get lost, you lose your money. Remember, I told you guys like now, as this market move from here to here, as this buy happened from here, hold on, from here to here, that buy. Remember, retail traders are also inside here. Now, what makes these big moves are big institutions. Now, if I should zoom in, let me zoom in. If I should zoom in now, you see big candles, big volume candles buys. That will show that institutional traders, those that are trading $500 million and all, started buying. So now, hence pushing the price upward. Remember, I told you this the forex market, even the crypto market, forex market also is bigger than the crypto market currently still, right? But though the crypto market is trying to dominate, but the forex market is still bigger, right? Because they're trading currency pairs against another currency, another currency against another currency. Hence, currency pair. You're trading the USD against the Canadian dollar. You're trading the euro against the against USD. Okay, so now I'll explain what a bearish market is. This is a bullish market. Then here, over here, from here to here is a bearish market. From here to here is a bullish market. Then overall, has been bullish from the outset. Why? Because it's just been going up. Though it went up, came back down, still went back up, came back down, went back up, came back down. That is up again. So it's bullish market. All right. Okay. So going back. So when you hear someone say bullish market, you know what that means. When someone says bearish market, you know that means the bullish market buyers who don't they buy for the market they go up. Bearish market people don't they sell, the market they sell, it they go down. All right. Ranging market, ranging market, ranging market is when markets either moving upward nor downward. In this case, it has no clear direction. Trending market is when the market has a clear direction, either bullish or bearish. Ranging market, an example of a ranging market. Let me go to GBPCHF. That pair they like range too much. Okay, let me talk and finish. Though this overall trend is bearish, but they like range. Let me go to the 1 hour and we'll see how it likes range. Okay. Yeah, market structure was still clean. Hence me. No, the market structure was still clean here. Market structure. Okay. This is an example here at this point here. Oh, sorry. Doesn't Euro CHF, sorry. Wondering what's really happening. Okay. Alright. This is an example of a ranging market. Alright, here. I see this guy. This is an example of a ranging market. You can see market was neither going up. It was going up from here. Expected to go up. The next it was going down. This it was going down. The next it was going down. It's ranging, right? The range doesn't have a clear direction. Which. Yeah, something like here. Market is ranging. It's not breaking highs. Something like also this one here. See the range. It's not going up, it's not coming down. It's not going up, it's not coming down, it's not doing like this. It's just one place going up, down, up, down, up, down, up, down, up, down, up, down. Right? That's a ranging market. So when you hear someone say market is ranging, you should typically understand that. Alright? So going back, you have trending market. Trending market is when the market is when trending market is when you can clearly see that okay, this market is going up, it's bullish, or the market is bearish. It's clear. All right. So moving forward, to go long on to go long means to buy a currency pair after analysis. When someone says go long is when just like this odd card. Let me go to the chart. This beginners class, the way they take on a beginners class. Let us show that everything for charts. All right. To go long means to buy. So like what I did here, I took a buy from here to here. What I did here, I took a buy, market went to profits, came back to me at a break even. Right now, I feel this guy will still buy though. I need to take out this load and still bounce here again to buy. I'll be watching it. Just maybe I might forget, but I'll be watching it. So to go long means to buy. Then to go short means to sell. Go long, buy, go short means to sell, right? So simple as ABC. To go short means to sell a particular pair. Same thing here with a long position. To go long means purchasing a specific currency pair. Then to go short, a short position means selling. All right, angel investor. It's what they call a kind of wealthy individual who funds startup businesses with capital in exchange for debt or equity, right? Then Bollinger Band, this is like imagine around the price of a crypto or Forex that helps indicate when the market is overbought or over. So Bollinger Band is just more of like an indicator. It helps shows you when the market is going up or when the market is bearish or when the market is bullish. BTD, connoting to buy the dip. When you hear people in crypto, they say buy the dip, buy the dip. That's when the market is dipping. So they expect you to buy the dip, buy it at the as it they sell, buy the dip. Same thing. Then buy the fucking dip, still the same thing. BTFD, right? Bull trap. Bull trap is a situation when a general trend reverses briefly and subsequently continues to the its movement to the downside. So bull trap is example is when the market is pretending like it's bullish. That happened to me here Euro CHF. Right. Hmm. I had an analysis here. I didn't take I had trade here. I didn't take it. Wow. Okay. That happened to me here. Though it still bought to it from here, it bought to my direction, but later the market came back. That right? Right. So bull trap. Market started creating higher highs, higher lows, higher lows. Started going up like it was going to go up, but then the bastard followed his trend. I think this is United where Trump just entered power and he was fighting with what do they call those guys? He was fighting with China and fighting with yes, China and there's this other country increased tariff on. Forgotten. It's not only China, two countries. So then the market started selling like this. So the market just sold and deceived me. So the bull trap is like market pretending like it was going up, then start selling. Then the bearish trap is the same thing, reverse opposite. Market pretends like it wants to sell, but then it starts buying, right? So then the bullish, I've explained what bullish means. Bullish, an expectation that the value of a specific currency will go into an increase. That's market you're expecting market to go up. Bulls, they are crypto enthusiasts or forex traders who expect the price of a coin or currency pair to go up. They are mainly optimistic. So, alright, bull market. I'll explain what bull market is. Bull wall, a huge amount of buy orders placed at a market price. Buy wall, sorry, where people are expecting market to come to a particular price and they buy. Understand? Then do DYOR. You see most people on X on Twitter they'll post something and they'll be like DYOR. They'll post a particular meme coin or something, or they'll post an analysis on Forex chat or stock, whatever. They'll tell you do DYOR. That connotes to that simply means do your own research. I tell you this thing why I post or this one I talk, do your own research about it before you even take actions or something, right? Then FA is an abbreviation for fundamental analysis. I've talked about fundamental analysis countless times, right? Then FOMO, FOMO. FOMO means fear of missing out. When you are traders, you tend to have fear of missing out, right? When you're trading and you have a particular trade in mind, you will now be scared, fear of missing out on the trade, potential profit, or fear of missing out on potential losses, etc. Then we have food, FUD. Food is the fear of uncertainty or doubt. Food is fear, uncertainty, doubt, right? So when you have food, it means you have FUD. It means you have fear, uncertainty, doubt. So you have fear about your analysis, or doubt about your analysis or your strategy, or doubt about what the setup, the trade idea you have, whichever. So you have food star. Someone that is a food star is just someone that has fear, uncertainty, and doubt when trading. Food star. So hold, HODL. It connotes to hold on for dear life. So you hear it's mostly used in crypto, where you hear people, the traders, they say hold on for dear life, right? HODL, hold on for dear life. That they to hold the coin forever, it will make you millions, it will make you blah 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 whatsoever. You get. So they have JOMO, joy of missing out. JOMO is when you have people that are very, very happy and they're like, oh, I'm going to make X amount of money, I'm going to make X amount of money, I'm going to X amount of money if I buy this coin. Once I buy this coin, once this coin pumps and you see them, they'll rush. So, oh, might not miss out in the fund, might not miss out when the coin go turn $1. You now buy 2 billion pieces of a coin, or let's say a trade. A trade is given a trade analysis and say, oh, this guy don't post this trade analysis, make I know follow miss out, when I follow print money today, the joy of missing out, rush to buy, that's Jomo. KYC, you guys should know that one. KYC is know your customer, right? KYC. Limit order, this defines to certain limit order is orders that you drop when you want to take a trade, when you want a price to reach a particular point and your broker to trigger that trade for you, right? So limit order, let me explain it here because I know later on I'll explain that, but this is like now I want to sell from this price. I wanted to sell from this price here. So what I was going to do was I will set a limit order on this price here with my broker. So when market goes up from here, touches that price, it will trigger and to sell, and my trade will be in profit. If market doesn't reach that price, it will not trigger. So that's limit order. All right. Then we have liquidity. So liquidity, the availability of an asset to be bought and sold easily without affecting its market. Liquidity is simply money put in the market. The availability of cash flow in the market where others are in the market, right? Liquidity swap here is a situation where investors offer loans to others to trade within the exchange as return. As a financial instrument on crypto exchanges, liquidity swaps or contracts. Then it's called pump and dump, where you have pump and dump markets, pump and dump pairs, whatever. That's when you have a currency pair going up, coming down, going up, coming down, something like this. I've forgotten, but pump and dump happened last week. That was when China need to also pay attention with news and economic factors. You know that Donald Trump raised the US economy has been underrated somehow and valued overrated somehow. And also the US economy, they have been America in quote has been cheated severally. But because mostly they export or they import, yeah. They import most of their stuff and most of the stuff they create inside America to export, they import the raw materials to do so. So I was trying to make a stable economy for them to increase tariffs so that Americans, instead of going to buy things from China because there's a tariff on it and the prices are skyrocketed, like have been hyped times three or times four, they'll go to buy what is locally used. So instead of buying a cup that is made in China, you buy a cup that is made in America because it will be cheaper, and that's about half. China will be higher price based on the tariffs that we put on it. You guys understand the tariff now. When you purchase it, import something from another country that, let's say he put the tariff on China. So when you purchase something to America, once they put the tariff and exchange and the customs there, all those stuff like that, the price goes skyrocket. So you guys selling it over here to make your profit, you go need increased price so that you fit cover up what you used to clear the goods and see your profits to recycle your business, right? So increase tariffs, and that's what happened. Market fell. I showed you guys on the chart of the Euro CHF chart. Market scattered. Market crashed. So it was on Monday. He reduced the tariffs. He was thinking China. I think it's China and Japan. Jordan, I don't remember. I can't remember. I think I should Google that. I'm not mistaken. Um. Okay. Think it was China. I think it was Japan also. Uh, Japan was also affected too. He also increased it for Japan, but he didn't announce it. So that was it upper last week, upper week. He came back, Trump came back. Since he saw that China didn't answer him and they didn't feel threatened. So he came back and reduced it to 20 something percent, I think. So them to over there, China to they also reduce their own tariff on US because China's over they said that any products imported uh, from China tariffs will be placed. The same tariffs Trump placed over there, same thing. So when he reduced that the tariffs he placed on China's goods to 20 something percent, to 20 something, 30 something, China on the other hand reduced their own tariffs they place on American goods. So that's what created pump and dump in the market. Upper week it was. You see the market, it go pump, it go dump, pump, it go dump. So that was an example. That's a clear example of the pump and dump. So the RSI stands for connoted relative strength index. RSI. It is a trading indicator, no doubt. It shows you the strength of the currency pairs, right? It's an indicator that frequently shows the employment rate, kind of, yeah, I think it's the employment rate. But mostly it's something that if you add your RSI to your analysis, right, you have good points. It serves as a good confluences for trading. It gives you assurance, right? Backed up with the data given, gives you an assurance that at least if you're using it the right way, or that's if you're using it the right way, it gives you an assurance that whatever you're doing, at least it's rhymed. Because if you want to sell, you want to buy, RSI indicator will show you the market at a good point. You should buy, you should sell. Though you cannot use that alone to trade. You use that alone, you make huge losses, but it helps as a confluence, added reason to take a trade, something like that. If I should put it like that. So down, you have TA, technical analysis, right? Explain that. So that's all we have for the common forex terminologies. I remember, guys, my brain gets stronger every day because I exercise it. The stronger it gets, the more money I can make them. Your brain gets stronger every day when you exercise it. The stronger it gets, the more money you can make. Alright, so that's that for common forex trading terminologies, right? Then let's move over to introduction to, where's my mouse? Alright, I think we're gonna finish this today because it's going to be an hour. This is 9:53. Introduction to candlestick patterns 101. Starter course. So remember I told you candlestick charts. There's a candlestick chart, there's the bar chart, there's the line chart. So in the candlesticks, there's what we call candlestick patterns. What are candlestick patterns? It's when on the chart different set of candlesticks come together and something form a particular pattern, right? That has been recognized, that has been seen over time and documented that it plays out. And each pattern gives a significance, a meaning. Remember, I told you on the candlestick chart, each candlestick represents transactions made. So when certain transactions were made at certain time frames, and each of those candlesticks coincidentally form that pattern, shows that something in the market, there's something that's going to happen in the market. That is going to be a pump, market is going to buy or sell whichever candlestick you see there. All right. So I hope I've been able to explain that. So you guys should go through all the materials I've done. I've tried my best to make them as simple as one can read, one can understand, and one can. It's also self-explanatory. If you go through it, if you in-depthly, you seriously want to go through it, you understand every topic. All right. So introduction. While candlestick chart may be seen common today, this approach didn't gain worldwide popularity until 1990, when when they were first introduced to the Western world. With humble beginnings dating back to investors forecasting rise in price in the 18th century Japan, candlesticks are now most common way of charting in most financial markets, including the core digital assets. To many novice investors, this chart contains varied and often complex patterns can be overwhelming. However, even a basic understanding of how to read and recognize these patterns can help traders price action insights. These candlestick patterns can help your price action insights. Remember, I told you that each of those candlesticks form from different transactions that are held in the market, and those each candles come together to now form a pattern. All right, so it can help your price action. What is price action? I don't really need to go into deeply into that, but price action is just understanding the information. I've already done price action today, sir, but not in depthly. Price action is simply understanding the transaction that went on each candlestick, interpreting each of them. Simply, that's like price action. right? So context of a candlestick. Context. Sorry. What is a candlestick and what are candlestick charts? How to read a candlestick? Body wicks, highest high. I've already explained that before this self. Well, so this is a candlestick chart. I've showed you guys a candlestick chart, right? And how to read a candlestick chart. I've typed this out, but I've explained this already, so no need for me to go through this already. Remember, I told you the red candle and the green candle. The green candle represents the bullish market is bullish. The red market is bearish. When market is bearish, that means people are selling, sellers. The green bullish buyers, people are buying, right? The market. So I explained all that here in this material. I don't want to go in detail because I already explained that because of answering others. So let's go. Key trading patterns to know. Key trading candlestick patterns. So we have the hammer. There's a hammer. There's inverted hammer. There's shooting star. There's hanging man. There's morning star. There's bullish engulfing. I'm mentioning these are types of candlestick patterns. There's bullish engulfing. There's evening star. There's bullish, bearish engulfing. There's piercing line. There's three white shoulders. There's dark cloud covering, and there's three black crows. So now, the candlestick pattern I use as confirmations. For me, I use hammer. If it's not a hammer, I use it mostly on daily time frame. I use the bullish engulfing, and the rest are bullish and bearish engulfing. The rest I don't really, and also use morning star sometimes. So, all right, those are really effective for me. So now here I talked about each candlestick. You have the hammer. This 9:58. I don't Okay, let me talk about this hammer, then tomorrow we'll continue about the rest, right? So now in the candlestick types of candlestick patterns, we have the bullish candlestick patterns, we have the bearish candlestick patterns. When you see the bullish candlestick patterns, this indicates that price will start, markets will change directions to being bullish if they were bearish, or they'll yeah, from if they were bearish to start being bullish, right? Shows an indication that there'll be a change in price action. Market, if they were selling, will start buying, right? Then for the bearish candlestick pattern, vice versa. When you see any of that, it shows that market is going to be, from this point, going to be bearish. But it doesn't work all the time. But depending on the scenarios, you need to find them on key points, which I'll show you guys later on. I'm not sure, but I think that's also part of the course on the beginners, right? So now I'm talking about type and a hammer. The hammer is part of a bullish candlestick pattern. Once you see the the hammer candlestick pattern is formed of a short body and a long lower wick. It's found in the bottoms and the downtrends. So I've explained the appearance here, explained the indications. Okay, let me explain the appearance. The hammer is one of the easiest patterns to recognize. Like, it's like a hammer, you just do like hammer. I'll show you guys on the chart. This pattern is made of a candlestick with a longer lower wick and a bottom down trend. This body is usually small with little to upper wick. So remember, what is wick? This is what we call wick. This is wick. You see this long thing here where they like broomstick? That is wick. All these are wick. If you go to the course, I explained that. Let me go up. Yeah, this is wick. We've seen that wick. When, like now, this market, sellers, buyers start to push market up, then creating this wick here, the small wick. That's wick. So now they're telling you, I wrote here that to see a hammer is formed by a wick and a small body. So what does a hammer indicate? It indicates that it has a strong reversal trend and a potential price surge. This pattern shows high selling pressure. However, during the same period, the buying pressure retook the control of the price action. So let me go to, okay, I already did this. This is an example of the hammer. Have you seen it? I drew it, carved it out. So let me go to the chart. Let's point out a hammer. Alright, we have seen one. I've already seen two already. So this is an example. See a hammer here. See this red candle? See that red candle there? That is a hammer. Are you guys with me?
Yes.
Okay. Let me know if I'm not talking to myself. Alright. Okay, this is a hammer. There's a wick and there's a body. So it's like a hammer. Right? So it shows this a reversal. The market will be reversing. Strong market reversal. So if you see after the hammer, what the market do? Started selling from here. You can see market from here was buying to this point. After the hammer, you see strong reversal. Everywhere sell. The market sold down. Alright. So that's an example of the candlestick pattern. I think our time is up. I will explain the rest. Continue from here tomorrow. Type of candlestick where they invest hammer, inverted hammer. Well, I will explain that tomorrow, but you guys can read up, right? About the hammer. The invest hammer is just simply let me find it. Okay, this is it. See it here. Invest hammer, but yeah. Have you seen it? That one. This is it. Invest hammer. Check here. Have you seen it? Same thing we have over here. Invest hammer. Inverted hammer. Alright. So that's that for that as far as that is concerned. So we call it a class day for here. This is 10:03. So till tomorrow I'll send the the videos of everything we had today and since Monday to you guys, to all the emails. I collected all you guys emails. So is there any questions? Any questions? Alright, so there's no questions. Call it a day. See you guys tomorrow. Alright, take care.